Hello students. This video lecture is an initiative taken by Shet Vidya Mandir Junior College of Commerce and Science. This video lecture is for 12th standard students. Subject is Secretarial Practice and our today's topic is Corporate Finance, which is our first chapter. This video lecture will explain you various aspects of corporate finance, and at the end of the video I will be giving you one bonus tip. So let's start. Students, corporate finance is also known as business finance. The term corporate finance comprises of two terms, corporate and finance. Students, corporate means big firms like joint stock company, and finance is related to money and management of money. Corporate finance primarily deals with raising of funds, that is collection of funds from various sources available in the market, and then investment of those funds in a systematic manner, in an efficient manner to get a higher returns. The definition of Henry Hoagland also explains the same, but corporate finance is a wide concept. Not only includes the raising of funds and investment of those funds, but it also includes activities like financial planning, capital market, stock market, and money market. Definition of Henry Hoagland emphasizes mainly on raising of funds and investment of those funds effectively and efficiently. But before learning raising of funds and investment of those funds, you should also know what is financial planning, what is stock market, capital market, and money market. We will go through this concept at basic level. Let us have a glance on financial planning. It is one of the important activities of corporate finance. Here, the role of finance manager is very important to project the future requirement of finance. That means a finance manager has to make a plan, he has to forecast his financial requirement. In this process of financial planning, the finance manager and the firm comes to know about their capital requirement at initial stage. They come to know for what period they will require the funds. Capital market. It is a market from where a firm, a business enterprise can raise capital for a long period of time. For example, 3 years, 4 years, 5 years, or more. The instruments can be debentures or equities. Money market. Money market is a market from where a business enterprise or a firm can raise capital for a short period, that is, less than a year. The raised funds can be for the period of days, weeks, or months. Stock market. It is a market where securities are traded in a systematic manner. Securities like equity shares, preference shares, debentures, bonds, public deposits, etc. Stock market is also called as share bazaar or share market. So, here we can see that corporate finance not only involves activities of raising of finance and investment of those finance, but it also includes financial planning, capital market, money market, and stock market. Now, let us see the most important and primary decisions of corporate finance, that is, financing decision and investment decisions. So, let's start with financing decision. As we have access to capital market from where we can raise capital through equities or debentures to fulfill our financial requirement. The finance manager has to make a proper decisions in relation to amount of capital raised from equities and debentures, as he has to maintain and balance a debt equity ratio. Debt equity ratio is a ratio which expresses the amount of capital or proportion of capital raised through debt finance and owned finance. If the amount raised through debt finance is more than the amount raised through owned finance, then company have to pay a fixed rate of interest whether the company is making profit or not. Example of debt finance is debentures, bank loan, public deposits, etc. And own funds refers to share capital and reserves. There are two classes of shares, equity shares and preference shares. Here, the manager has to balance a proportion of equities and debt finance. Now, we will see investment decisions. Due to financial planning, the finance manager comes to know about the financial requirement, and through finance decisions he can select the proper sources of funds. Here, the finance manager has to invest those funds effectively and efficiently so as to get a maximum returns, as one wrong investment decisions may lead to many losses. Depending on the nature and type of business, the funds should be systematically invested in fixed capital and working capital of the firm. Investment in fixed capital means investing funds in fixed assets of the firm. Example, land and building, plant and machinery, equipments. Investment in working capital means funds invested in short term assets such as cash, receivable accounts, and inventories. Inventories means stock. Investing of these funds appropriately or utilization of these funds effectively is very important, as it will give us a maximum returns which will create a goodwill of firm in the market. This activity of investment is also called as capital budgeting. Now it's time for the bonus tip. In bonus tip, I will be explaining the conclusion of video in हिंदी. कॉरपोरेट फाइनेंस ये कंसेप्ट हमें ये समझा रहा है कि जॉइंट स्टॉक कंपनी को बिजनेस करने के लिए शुरुआत में कितने पैसों की ज़रूरत है, जो वो फाइनेंशियल प्लानिंग करके फाइंड आउट करेंगे. फाइनेंशियल प्लानिंग करके हमें ये पता चल गया कि हमें कितने पैसों की ज़रूरत है. अब फाइनेंस मैनेजर को ये डिसाइड करना होगा कि पैसे आएंगे कहाँ से, पैसे आने का ज़रिया क्या रहेगा. वो पैसे इक्विटी शेयर्स इशू करके आएंगे या डिबेंचर्स इशू करके आएंगे या पब्लिक डिपॉजिट्स, बैंक लोन और बहुत ज़रिए हैं जिससे हम पैसे जमा कर देंगे. इसे हम कहते हैं फाइनेंसिंग डिसीजन. अब जब हमें पता है कि हमें कितने पैसे की ज़रूरत है और वो पैसे कहाँ से आएंगे, तो अब हमें इन पैसों का सही इस्तेमाल करना है, इसे इफ़ेक्टिवली यूज़ करना है ताकि हमें नुकसान ना हो. पैसों को प्रॉपर इन्वेस्ट करने से कंपनी को फ्यूचर प्रॉफिट्स अच्छा होगा और अच्छे फ्यूचर प्रॉफिट से हम हमारे इन्वेस्टर्स को अच्छा रिटर्न्स दे पाएंगे. इससे हमारी कंपनी की गुडविल भी बनी रहेगी. अगले वीडियो लेक्चर में हम देखेंगे इम्पोर्टेंस ऑफ कॉर्पोरेट फाइनेंस. थैंक यू.